Welcome, everyone. We are so glad to have you joining us tonight for our Money Matters event brought to you by Pima Community College in partnership with the First Year Experience Program, the Office of Financial Aid and Scholarships, and our community partners, OneAZ Credit Union. We have a great event for you tonight, which we are excited to begin. We're going to give everyone some time to get started and logged in. And while we do, I'm going to ask you all to just review the steps that are on the screen so we can make sure we're all on the same page for tonight's event. So let's go through those one by one. First of all, please check your Zoom profile to please make sure that it shows us your first and last name, as well as your pronouns if you wish. That way we can get to know you a little bit better, know how you would like to be referred to throughout tonight's event, but also, and perhaps most important of all, we can be able to track attendance and record that you were present with us tonight. Whether that's because you have a teacher at Pima who's willing to offer some extra credit for being here tonight, or so that you can get entry into our special prize drawings that we will announce and share more details about later. So if you're not sure how to update and rename that Zoom profile, there's a couple different ways that you can do so. Option number one is to please go down to the bottom of your Zoom toolbar, click on the Participants tab. It will give you a pop-up window that appears, and your name should be at the top of that list. Hover your mouse next to your name and you should see 3 little dots appear. And when you click on those, it will give you the option to rename your Zoom profile. Another way to accomplish the same goal is by looking up at the top of your screen where you should see everyone's webcam tiles, and yours should be at the front of that row, even if your webcam isn't turned on yet. Hover your mouse over that Zoom webcam tile, and you're going to see, again, 3 little dots that appear in the top right corner. Click on them, and it will give you the ability to rename your Zoom profile. Now, please also know that if closed captions would help you with being able to learn and follow along with tonight's event, they will be available to you through the Zoom automated transcript. To access those, please go to, again, that Zoom toolbar. Click on that tab that says More with the 3 little dots, and then you should see the option to show captions or enable subtitles. If you have any questions or challenges with that process, let us know in Zoom chat so we can support you and help you troubleshoot. Now, please be aware that tonight's recording is being recorded for educational and promotional purposes so that you have a tool to look back and watch later to listen to all the great information we're going to be sharing in replay, and also so that other students who weren't able to join tonight's event live can still watch and learn from the information we have to share. Now, if you do not want to be part of that recording, you are welcome to leave your web camera off. You will still be able to fully participate without that on. However, we do welcome you to include and have those webcams on because we love to see your faces, and it just helps us build that sense of community. So I see Joel joining us tonight. There's Simara, and I'm also seeing Anna. Thanks so much for joining us tonight, everyone. I'm excited. I think it's going to be a great event. Now, to make sure that we all have a smooth session and that we're able to easily hear the speaker, we do ask you that you please keep your microphones muted unless you are being asked a question or it's your turn to come off of mic. That's just so that we can all be able to easily hear and follow along. We get it, things happen beyond your control, like maybe the dog starts barking in the background or a colleague comes walking into your office not realizing that you're in the middle of a meeting. So by keeping those microphones muted, it'll help us all be able to easily hear the speaker at hand. However, we want this to be a fun space where you get your questions answered. So throughout tonight's entire event, if you ever have a question come to mind, please make sure that you ask those questions in the Zoom chat box. Myself and my colleagues will be banking those questions to make sure that they get fielded and answered by our experts throughout tonight's event. Now, in addition to wanting this to be that fun space where you get your questions answered, we also want it to be a safe space. So we thank you in advance for making sure that we keep the conversation respectful, civil, and clean. Now, also, as another way to track attendance throughout tonight and make sure that you're present with us throughout the entire event, at the end, we are going to be asking you to complete a feedback survey through a bit.ly link that we'll share again later at the end. We just want to give you a heads up now so that you make sure that that survey is going to be how you receive full credit for being here the entire time. And that's going to be what enters you in some special prize drawings, including a special opportunity to win a $250 tuition award. And so when you attend both this and our April event, you attend the entire event and you complete both of those surveys, that's what will get you entered in the drawing to win that $250 tuition award, which can be applied towards tuition costs at Pima Community College in the summer and fall semesters of 2023. We also have some other prize for opportunities that we're going to be giving away throughout tonight. So if you follow us on social media, you will be entered in some prize drawing to win some Pima swag items. So the accounts you're going to be looking for is at Pima FYE on Instagram, Facebook, and Twitter. And then to follow us on our financial aid page, you're going to be looking for the handle pima.financialaid.scholarships on Instagram. So if you follow both accounts, you've given yourself 2 entries into that prize drawing, and we will announce 2 winners by the end of tonight's event. Now, our generous partners at OneAZ Credit Union also have some special prizes that they are going to be giving away. More details on that to follow, but basically just follow along, stay with us till the end, follow us on our social media, and you've got a lot of good things potentially coming your way. All right, now it does take a village to plan these Money Matters events, and so we want to take a moment to introduce ourselves in case we have not yet met. My name is Renee Forsyth. I use she, her, and hers pronouns, and I am the program coordinator for the first year experience program at Pima Community College. We strive to connect new students with important resources to help them at Pima and beyond, including building your financial literacy skills through events such as this one tonight. And I work with an incredible team from the Office of Financial Aid and Scholarships. So I'm going to hand the mic over to Carla.
Thank you, Renee. Hi, everyone. Welcome. My name is Carla Gonzalez. My pronouns are she, her, and hers, and I'm the Assistant Director of Scholarships and Outreach. And we're here to also collaborating with our partners from OneAZ and FYE, but also to provide financial literacy information to you all. So we're excited about tonight. And with that, I'll hand it over to my colleague, Juanita.
Hi, everyone. My name is Juanita Bonillas, and I work with Carla on the Office of Financial Aid and Scholarships. On her team, I manage the Second Chance Pell Grant program, and my pronouns are she, her, and hers. And I'll pass it to Anna.
Good afternoon, everyone. My name is Anna Brown. I go by the pronouns she, her, hers. I am the coordinator for scholarship operations within the Financial Aid and Scholarships Office. And I'm new to the team, so I'm excited to be here and learn along with all of you. Simona.
Hi, everyone. My name is Simona Duarte. My pronouns are she, her, hers. And I am the program coordinator for outreach and scholarship database operations at the Office of Financial Aid. I'm also new, and I look forward to today's presentation with all of you. And I'll pass it over to Vanessa.
All right. Good afternoon, everybody. I'm so excited to be back for another presentation with all of you amazing students and partners. My name is Vanessa Alfaro, and my pronouns are she, her, and hers, and I am our regional sales leader here in the South. So excited to be here again.
And we have a wonderful expert who's also joining us, and he will introduce himself in a moment. But first, what I want to go ahead and do is show you a quick preview video to kind of give you a taste of what we will be talking about tonight with our featured topic, which is investments and retirements. So allow me a moment here while I get this queued up, and let me get the video started.
Welcome to the Wonga Money Academy. This time around, we'll be talking about investing, one of the 4 pillars of financial literacy. Investing means putting your money into something that will make you a profit. The something, otherwise known as your investment, can become a second salary, or it may become more valuable as time goes by. That way, if or when you sell, you'll make more money than you originally invested. What sort of things can you invest in though? Property, retirement funds, unit trusts are some popular choices. When you invest in property, the plan is either to rent the space to tenants or to fix it up and resell it at a higher price. Investing in property is generally a good choice as the chance of your investment growing in value over time is excellent. Investing can also help you to plan for a comfortable retirement. There are different ways to do this. Some employers set up a retirement fund for their staff, who invest money in a fund while they're employed. They receive regular payments from the fund once they retire. Then there is the retirement annuity option. This is a private pension plan because rather than making payments into a group fund, the idea is to go it alone. You can choose between investing in the fund whenever you have extra money or keeping to a regular payment schedule like monthly or quarterly investments.
All right, so again, that's just meant to be a taste of what you can look forward to for this. So I'm going to go ahead and pass the mic back over to Tom so that he can present for us.
Right. So I need to share my screen, correct?
Yes, please.
All right, I'm gonna get it going right here. See if that works correctly. How does that look?
That looks great. Thank you.
Excellent, excellent. Well, let's get started. I'm with the OneAZ Wealth Management team and would like to go over a number of things. I'll do a little introduction of myself here in a moment, but just for some compliance purposes, wanted you to know that we actually are presenting this presentation as educational and informational only. It is not intended to be any legal, tax, or investment advice directly to any individual. If you're looking for individual advice, we're more than happy to meet with you or talk with you on a one-on-one basis. But clearly, we're here to provide some great education, some great concepts that you can take from here and do it on your own, or you can go out and seek counsel from anyone that is properly licensed and equipped to do that for you. So wanted to give you that little reference. Also, if you'd like to connect with OneAZ Wealth Management directly, I'd like you to know you could check out our QR code here. That takes you directly to our website. And on our OneAZ Wealth website is lots of information from videos to articles, calculators, even investment commentary that we have on our website for use. And it is an open public website. Anyone can access it. So I urge you all to use that or to reach out for more information. You can also reach out to us directly at OneAZ Wealth for any individual questions that you have. If you'd like to meet with one of our advisors, we'll make that available too. All of our advisors meet with our members on a complimentary basis, on the initial basis. So we'd be happy to meet with anybody that would like to have that kind of consultation. All right. Okay. So let's get started. The presentation that I'm going to be doing today is how to build your own wealth plan. My name's Tom Mitchell, and I happen to be the leader of the OneAZ Wealth Management team located here at the OneAZ Credit Union. You can reach me by my email address or even connect with me on LinkedIn. We are a group of 8 advisors with LPL Financial is our broker dealer. And we are making all the different non-deposit investments and insurance products available to the credit union members of OneAZ. And we'll go reach out to the general public. But more importantly, it's to anyone that would like to have access to great education, great counsel, and help them make a difference in their financial lives. So let's get started. First, I'm going to talk about a number of things tonight. First, I'm going to go over the OPM method. I'm going to talk about the 5 key components of a wealth plan. I'm going to talk about how do you measure up? How do you compare to others? And also, so I want to make sure there's some key takeaways that you'll have for tonight. All right. So let's first talk about this OPM path. This OPM path is OPM. What does it really mean? Well, the first is the O. The O means we'd like you as any individual to make sure you organize your financial data and you organize your goals. So as you start down any wealth management or any wealth growing plan that you'd like to develop your wealth, you need to be thinking about, how do I assemble my assets together? How do I know what my goals are? What are my objectives? So that begins the planning process. So through the O, it's getting all that organized. That's the first step. The second step is the P. The P is planning and projecting. Planning and projecting various scenarios of what we might be able to do, what you might feel comfortable in doing with your investments so that we can achieve those goals. And then lastly is that following up, that monitoring and managing the process. It's very, very important to be checking in on an ongoing basis, whether it's once a year, twice a year, whatever it might be. You need to make sure you're managing and monitoring where you're going. And if you notice, it's a circle. So it constantly is evolving, and clearly it's going to be changing as you continue to age. You're going to have different goals, different objectives at different stages in your life. So hence, your OPM plan will also be needing to be changed and addressed as well. Okay, let's start talking about some of the real basics. And maybe some of you have seen this before. And I'm reminded by the Egyptian pyramids, right? They've been around for centuries and centuries. They've been around because they're stable. They have a strong foundation, a lot of basic strength, and a lot of logic in that engineering of how that pyramid was built. Well, we can apply that same concept when it comes to investing. And what I like to call out here is looking at a foundation of your financial pyramid is very important, because once you build your foundation, and what am I talking about here? I'm talking about savings. I'm talking about money markets and life insurance, and really just having a good, strong foundation so that you can then start to look at investing, and you look at different styles and different risk levels. If you notice, the pyramid goes up and it goes from conservative growth all the way to the top being speculative. And the speculative is the most risky. And sadly, some people think they can jump right up into the top. Well, the most important thing is to make sure you have a foundation, and then you gradually grow as you continue to amass your assets and your wealth. You start to build and you start to go up the different levels of the pyramid. So I always like to use this illustration, and many times I'll even put in the client's assets in looking at where they are in that pyramid. Are they top heavy, or are they too bottom heavy as well? It's so important to have a good, strong pyramid so you have a good wealth plan overall. Another thing we like to do is take a look at the three pockets. The three pocket analysis is taking a look at where you have your assets during certain periods of time and your needs, okay? And their pockets, meaning short-term would be that less than a year, mid-term is 1 to 5 years, and then the long-term is beyond that. So let's use an example of Casey. Casey actually has some short-term needs. She has a birthday party she's planning for. She also has some dental work she needs done. So she needs to make sure, or he needs to make sure, to have assets set aside to meet those needs at that stage in their life. So that's 1 to 12 months. Then when they get into the midterm, they may have a family reunion. They may have a new car. They may even have a kitchen remodeling they might want to think about doing. Those things need to be thought of and planned in that 1 to 5 year. There are investments that are designed for that 1 to 5 year stage that are different than the short-term stage. And then when we get into the long term, we talk about the college fund or a new roof, for example. Those are all important. Retirement accounts, again, that's beyond 5 years. So when we meet with an individual, we want to make sure, do they have their assets in the right pockets for the right needs? Occasionally we'll come across somebody that has everything in the long-term pocket, and then when it comes time for something short-term, they have to do some liquidations, and that might not be appropriate. On the other hand, we'll have individuals that might have everything in that short-term pocket. And guess what? Having everything in the short-term pocket doesn't make sense either, because there are investments that are better suited and actually perform better and give a better rate of return the longer term you can think and the longer time frame you can build it out. So it's a great little illustration, making sure you have your pockets well balanced in your plan. Okay, let's talk about the 5 basic components of everybody's wealth plan. Well, these are important, whether it's for you or for your parents or your grandparents or whoever it might be in your life. It's so important to recognize there are 5 areas of everybody's plan. So let's talk about the first 5. The 5 are capital accumulation. We're going to talk about risk management. We'll talk about retirement planning. We're going to talk just a bit about taxes and also legacy planning. All right. Okay, let's get started with capital accumulation. Capital accumulation, what is it? Well, it's a fancy word for investing, but it's more than just investing. It's really recognizing your risk levels too, knowing how you're going to allocate your assets, and making sure you're managing and monitoring and rebalancing them on an ongoing basis. So a common question I get a lot is, Tom, tell me, I need to know what the best investment it is to buy. Okay. Well, I don't know if you can see this chart. I apologize. It may be a little small, but what it shows you, we call it the jelly bean chart because it has so many colors. It's a jelly bean chart, and each of those boxes represent a different investment category for each year. And it goes back to 2003 and it finishes through just this December of 22. So it's a very up-to-date chart. But it shows where those assets performed, how they performed, ranking them from the top, the very best, to the least performer, which is at the very bottom. So let's use an example here. If you can just glance at the chart, and you can easily see these colors, I'm sure. Look at the red boxes, right? Oh, let's all go red, right? Well, if we went red, let me see if I can use my pen marker here for a moment. The red marker, these are actually the, oops. These are the actual investments. Let's see if we can get this pen to work again. It was working earlier. All right, let me see if we can get this pen to work. Okay, so if you look at these, the red categories, look how they go they were up there for a few years, then down, back up, back down, down, then back up a little bit, back down, then up some more, then back down, and on it goes. You see, actually that category happens to be international investing. International investing is one of the more volatile, and that's what I mean by zigzaggy. It's more volatile than some of the others. Then if you look at the box that are gray, the darkest gray boxes, those are, some would say, a lot less volatile. Look, they're a lot smoother ride. Some people like to use the analogy of the roller coaster. Well, this is the kiddie ride roller coaster. You notice it goes up and goes down, but it doesn't go up nearly as much or down as nearly as much. It takes out some of that volatility for a little smoother ride, a little better ride, and sometimes a better overall performance. And you can see on that last far right column, it shows the annualized rate of return. The gray box happens to be a diversified portfolio. A diversified portfolio is a little bit of all of the portfolios well managed in a diverse fashion. That actually returned about a 7% return over the last 20 years. Compared to internationals, if yes, you earned some 30% returns a few times, but the reality is you also lost some large percentages if you looked at how volatile that was. So that actually performed about a 6.5% rate of return over 20 years. So how volatile do you want your roller coaster ride to be? That's critically important as you start thinking about this. Okay. All right. So we're talking about risk. Let's talk about risk a little bit. And some of these questions I ask you to think about for yourself. You know, do I want my principal protected? How risk averse are you? For example, I have a hard time tolerating risk. Is that something you might say? Or would you say, no, I can tolerate some short-term risk and some volatility. Oh, I can tolerate moderate loss. I can even lose 10, 20% if I need to on the short-term basis. And then on the far side, hey, I've got a long time out there. I've got 20, 30 years out there until I need the money. So I'm willing to be very, I can be willing to take on high volatility and a lot more risk. So asking those kinds of questions kind of lays out now a spectrum for us. The spectrum, if you look at this spectrum, see if I can use my little marker again, see if it works here. Where did it go here? I'm trying to get on my thing. On the far left is what? Low risk. On the far right is high risk, okay? So if you notice, everything in the gray happens to be investment vehicles that are designed to be principal in a principal preservation structure, so that they're designed not to have principal loss, but actually have some upside return. The more you go to the right, which is the more volatile investments, actually have more volatility up and down. They actually have more risk of gain, but they also have a higher risk of loss. You've got to understand that and make sure you can manage that and stomach it. Okay. So one of the things I call out in that same chart is, if you look, everything in the gray, we kind of call that the savers, and everything over here in the blue area, we call those the investors. So thinking about that as you build out your portfolio, whether you're just starting or you might already have a portfolio established, where are your assets and how are they scattered around in their total spectrum? How do you fit into that? Another thing we'll do, and many investment advisors can do this for you, is there are called risk tolerance questionnaires, where you can literally go through a questionnaire and answer a number of questions, and the way you answer those questions will be scored to determine what your risk score might be. For example, if your risk score, depending upon how you answer these questions, it'll determine, are you a risk taker or are you a risk avoider? So it'll give you a high score if you're risky, but if you want to be very conservative, it'll be usually a low score. And then matching up investment styles and portfolios around those risk scores are very important. So that's a good call out there, and making sure risk. Last thing I'll say about risk. Most people don't know how much risk to take until they've taken too much, and then sadly, it's too late. So why do I say that? I say that because it's so important to get ahead of this. Make sure you know how much risk you're willing to take and understand how much you're willing to lose, because risk and some investments do have loss to them. Last year, in year 22, was the first year in many, many decades where most investment categories actually went down. So some of the most conservative strategies actually lost money last year also. Could you stomach that? Can you stomach it? So if you're young, you probably can. But if you're getting older and older and closer to retirement needs, it becomes less attractive. All right, so let's move on to the next slide. Every investment choice you think about, or even you look at, or want to consider, you need to recognize they have a style about them. And I like this little acronym STYLE, S-T-Y-L-E. Every investment has its own style. So here, I'd like you to follow along with me, and let's walk through these 5 letters and see what they mean. The first is the S, means safety of principal, making sure your assets are making sure you understand how safe is this investment. As far as when it comes to safety of my money, my principal, the amount I put in, how risky is it of me losing any of it or all of it? Making sure you understand that. Now, what do you think T stands for? It stands for tax treatment. Every investment will have different types of tax treatment. Some are tax favorable, some may not be tax favorable. Some might be tax-free, for example, tax-free state taxes and federal taxes. Some might be taxable. Some might be giving a better tax treatment. Those tax treatment strategies and all what they are, you've got to understand what they might be. Some might even be tax deferred. What do you think the Y stands for? It stands for yield and growth potential. What's the yield? How much am I expected to gain? How much am I expected to earn? How much can I grow my assets with this investment? So making sure you understand what that potential yield is. The L stands for liquidity features. Making sure you understand what are the liquidity features. Is it something I could sell very quickly, like a stock or a bond? I can sell it within minutes and have cash and available in about a day or two. Or is it a piece of real estate, for example? Real estate is not very liquid. You usually can't sell it very quickly. It takes time, takes process, and you need to think through the timing of that. So liquidity features is critically important when you look at any investment alternatives. And then the last is the E. What does E stand for? It stands for estate planning impacts. The most important thing is when you look at investments, you know they have style about them. They have safety of principal, tax treatment, yield, liquidity, but it also, how is it going to impact my estate? How's it going to impact my heirs, my family members that I leave behind? How is it going to impact them? And making sure you title it correctly, make sure you know how it will be owned as far as the needs, and actually how will it be managed through my estate? Will it be in a trust? Will it be owned by myself? Will it be in joint ownership? All those things and those characteristics of an investment will also impact your estate. Okay, so there's a quick little call out. When you look at any investment, make sure you look at the style. All right, let's get into the second category of the 5 basic areas, and that happens to be risk management. Now, I'm not talking about risk management when I'm talking about volatility of the stocks or bonds or whatever the investment you're looking at. I'm talking about your life risks. So the 4 worst things that can happen to anybody is 1, you become disabled. That's a risk of life, and you need to make sure you're planning, and you have planned around that. Also, what happens if I die prematurely? So if you die prematurely, then that's going to impact people that you leave behind, perhaps. So you need to make sure, how am I going to manage that? Or how are they going to manage without me? Is there going to be a shortcome in income for them? Or is there going to be quite a few debts that I leave behind? How are they going to get paid? So those thoughts have to be thought about, and you need to plan for those. Here's another one, property loss. Property loss. Well, if everybody on this call owns a car or has a car, you know you need car insurance, right? It's the law. So in effect, property loss is already built into some of our laws. You have your car, basically you have car insurance. If you have a home, typically you'll have homeowners insurance. If you have life, you need life insurance for life insurance and disability. Those are the first 2. But the last one here, the last one may not impact many people in younger ages. It's going to impact those that are aging though. What is that? That's the health. That's the health and long-term care issues. Some people call it, or I call it sometimes, living too long. Geez, I hate to even say that. But the fact is, we'll live longer, and we do live longer every year. And we'll talk about that a little later in the presentation. But making sure you understand those later stages of life do have expenses to them. It's called long-term care expenses that you need to be thinking about. How are you going to manage them? Or who's going to take care of them for you when you age? All right. Those are the 4 worst things. So let's talk about some of the other things about risk management. One of the call outs I want to mention is disability. People think, oh, I'm not going to get disabled. Oh, I'm not going to die. Well, take a look. And I broke it down by age brackets. That shows you the percentage of those in those age brackets that will experience a disability, whether it's a short-term disability or a long-term disability. The percentages are there. So if you're 35 to 64, there's a 12% chance you're going to have a disability. Well, you can roll the dice, but that tells me about 1 out of every 10 times that person's going to experience a disability. I'm looking at this Zoom webinar now, and we've got 50 people on this call. Approximately, if I did the math, okay, how many people would that mean that's going to be disabled? All right. So you got to do that math and say, wow, that means about what? Five people, okay, are going to experience, maybe 6 are going to experience a disability experience. How comfortable are you in that regard? Can you handle it? Can your families manage through that? Very important. Okay, let's get on to the third area, and that's retirement planning. Retirement planning is, I guess that's our ultimate goal, right? We all want to retire. We all want to enjoy retirement, and we need to think about it ahead of time. So when we're very, very young, it's really, it's kind of hard to even envision retirement. But if you look at your parents or grandparents or the older generations, you recognize retirement planning is critically important. Don't wait too late to start planning. The sooner you plan, the better. When I counsel people in their pre-retirement times, the biggest thing they tell me is, Tom, I wish I started earlier. I wish I started to invest earlier. I wish I had planned better. I wish I had wish. So I'm sharing this with all of everyone on this call, that it's so important to think about these things now. The sooner you can do it, the better. So retirement income strategies. There's all kinds of strategies. Managing your pension, if you're lucky to have one of those anymore. Pensions, there's only 6% of the companies in the entire country that have a pension. They have Social Security options, which we believe we'll have, but healthcare expenses as well. We got to make sure we have healthcare, and just the overall 401k plans, our general investment plans. 401k plans have been around 40 years now, 42 years actually. They started in 1979, 1980. And really, they were created to replace the pensions. But guess what? That means we have the responsibility to save money. If we don't put money in the 401k, it just doesn't happen. You've got to put money in to enjoy it later. So important to put money away for yourself so that you can have it and enjoy it much later. Retirement planning has some other areas that I'd like to talk about. Let me take a sip. One of the things I want to talk about is interest rates and inflation. Let me just show you this chart. This chart goes back, let's say 1958. And I want to show you that blue line. That shows you the treasury yields, the 10-year treasury yields started back in 1958, about 3%. And then it went up and up and up and up and up and up. And then maybe some of you, or maybe if some of you have heard some people talk about the 80s, the early 80s. Wow, we had 15, 16, 17% interest. Well, there it was, folks, there it was. Look how high it was. But since 1981, what has happened on a general trend line now? What has generally happened to interest rates? They have constantly fallen for the last 40 years. So it wasn't until this last year and a half where we've actually seen a spike, an increase in interest rates. See that? The interest rates have gone up. But if you look at the gray line is the net interest, the net after inflation. So when you had high interest rates, you typically have higher inflation. So what happens? Look at these lines down here. You lost money. You're actually losing money. Every time it drops below that line, the money did not generate enough to overcome the inflation factor. So we're dealing in a point in time now, inflation's about 6%. We're going to know now, well, actually tomorrow we're going to get a release on what the CPI is going to be. We're hoping it's going to get a little lower, but it's looking pretty strong and it's looking very hot. So those inflation rates are looking at 6%. So we need to recognize investments have to earn that or more for us to even break even. Now, I'm not saying to be aggressive and not to be risky with investments, but be aware of the difference between the blue line and the gray line. That's the difference from what you earned and what you actually net really earned is after that inflation factor. Big difference. Here's another a little way I like to illustrate inflation. And some of you might chuckle when you look at these numbers. Look, 1964, if you had a $100,000 CD and the certificate of deposit at a bank, the CD rates were what, 4%. That 4% earned about $4,300. Well, guess what you could do with your interest on that CD in 1964? You could actually buy two, not one, two Ford Mustangs. They were going for about $2,300 back then. You could buy two of them. Then you go 20 years later, interest rate was about 8%. And now you're looking at, oh, I can't because the Mustang has increased in price. That's inflation. It's gone up to $7,000. Now I can only buy one Mustang and maybe 101 full tanks of gas. Well, then again, another 20 years later, interest rates are going to, that same CD is going to only generate me about $2,600. Well, what can I get? I can't even get a Mustang at all. That's $18,000. And on top of that, what can I get? Maybe I can get a top engine kit to help my on my Ford Mustang. But here's the real staggering number. In 2001, interest rates were so low. Now they've come up a little bit, but they were so low, generating so little amount of money. And the Mustang cost $27,000. What could you really get? Well, you could get about 2.5 gallons of gas. That's it. Pretty shocking, huh? All right, next slide. This is, again, I don't want to dwell on it too much, but the power and the importance of recognizing when you invest, and particularly a longer term, inflation has its impacts. If you bought a CD, again, for 10 years, and we started 10 years earning 2%, it actually got you to $12,000. Here we are at the end of the 10 years. Well, with inflation at 3%, and we're just being conservative here, 3% inflation, actually, you lost money, right? You went backwards. So your account is really worth purchasing power of only $9,000, or really, what did we lose? We lost $3,100 in purchasing power on that $10,000 CD. So important. Okay, let's get to tax planning. That's number four, tax planning. And I call out a couple of things in tax planning. Tax avoidance, tax evasion. What's the difference? Is there a difference? Well, there sure is. Tax avoidance is legal. Tax avoidance is good. You can do things to avoid taxation that are legal. However, if you try to not pay your taxes or you do things illegally, that becomes tax evasion. That's a no-no. That puts you in jail. So I don't want you to evade taxes. I want you simply to avoid taxes when you can. So how do you avoid taxes? Well, you look at strategies like tax-free vehicles, tax-deferred vehicles, tax-advantaged vehicles, investment-wise, and how you build your portfolio accordingly can make a big difference in your life. So you want to manage your taxes, never pay more than you need to, and also look to diversify your taxes. Some are tax-free, some are tax-deferred, some are tax-free state, federal, etc. Making sure you manage your overall portfolio. Some people say to me, Tom, well, taxes are so high. They really are high. And, what do I do with this? And I don't, well, then I like to show this next chart. Wow. Let's take a look at the history of taxes. This goes back to the early teens of 1900. So this is 100 years ago. Boy, oh boy, look at the tax rates. Let me get out my little pointer again. Here, 60% tax rates back in the teens. And they stayed until about the 20s, and then boom, they dropped down. But boy, right here, what was that? About 1933. Then it stayed above, the highest tax bracket was above 60% all the way until 1980. Okay, 1980, big day. That year, that was some major change to tax reforms. When those tax reforms happened, that's when the tax rates were changed by government. And then they've been pretty steady since 1990. So look, when people say tax rates are high, no, they're not high. They're historically right now, probably the lowest I've seen or will see. For 40 years, they've been this low. Now, will they go higher? They possibly could. In order to pay some of the debt that we have, that might be a reason for increased rates. But all I know is make sure you look at things in perspective. Tax rates historically have been much higher, but we have enjoyed a low period of moderate tax rates, and now you need to plan around that accordingly. Okay, let's keep going. Let's talk about legacy planning. Legacy planning is the last part of everybody's plan that you need to think about, and that is what happens when I pass on. Where is my assets going to go? Where are my parents' assets going to go? Where are my grandparents' assets are going to go? So it's so important to recognize, do you have a plan together? Have you thought about it? And how do you get it to the next generation the most effective way? Do you have wills in place? Do you have trust documents in place? Do I want to donate money to a charity? All those things need to be talked about and managed. Just don't pass over it. It happens. Death is still hovering at 100%, or I say the mortality rate is still hovering at 100%. We all know we're going to die. They say two things in taxes and death are the two assurances in life, right? So we need to make sure we plan out and think through that accordingly. Let's talk about the life expectancy, because I'd like to show this chart. A lot of people say, where did we come from? Well, look at this. This is quite amazing. This goes back to the 1800s. In the 1800s, life expectancy, as someone being born in the 1860s, your life expectancy was about in your 30s. How about that? In your 40s, maybe. And it stayed there until we actually got here to 1880. Okay. And then some start improvements. some improvements of diet, improvements of medicines and so forth. That helped get us going. Then we had a dip. What do you think that dip's from? It's from the wars and some of the plagues. So we had the dip again. But again, life expectancy overall for a brand new birth was still in the low 50s. But then finally, from the 1930s on, we've seen a gradual increase all the way up to now it's 78 to 80 on average on a brand new newborn. Sometimes, depending upon other statistics, and you can really get into the details of regions of the country, family, genetics, I mean, all kinds of different nuances. We can even see life expectancies in the 80s, 90s, even in the early low hundreds. But so important to recognize life expectancy is on a growth trend, and I believe it's going to continue on this trend with new improvements in medicine. So recognize we will live longer. So that leads me to my last area I want to talk about is how do we measure up? Well, how do we measure up? We measure up by looking at what stage of life you're in, okay? Let's talk about the 3 stages of life. I call it the 30-30-30 stage, and some of you have heard me say this, but here's how it goes. For the first 30 years of your life, from 0 to 30, you're in your learning stage. You're learning who you are, what you're going to be, what your skill sets are going to be. You're getting your education. You're building out your whole employment strategy of what you might be doing in your life, etc. That's the first 30 years of your life. But then that next 30 years of your life, it's from 30 to 60. I call those your earning years. Those are what you're earning. You're earning money during those earning years. It's what you do with that money that's going to make a difference in the last 30 years of your life. So first 30 is your learning. Next 30 is your earning years. You're actually earning money. Well, from 60 to 90 is the last 30 years of your life. The last 30 years. I call that the burning stage because you're burning up, you're using up, you're enjoying the assets you've set aside and invested. So what do I say? If you haven't set aside enough, you're not going to be able to enjoy very much when you get to that last stage. So the more you can set aside, the better off you're going to be. And making sure you plan for that. Plan for life events. Do the reality check-in in life. What are those things that could happen during my life? And making sure I plan around those for my life. And making sure you have assets set aside. I'm asked this often, Tom, can I be a millionaire? Or is it hard to become a millionaire? And I can tell you the answer. It's not hard at all. It's not hard at all. I would venture to say, and this is a general statement, most people on this call could easily become a millionaire. The question is, how many are willing to take the steps to do it? How many are willing to commit to the steps that it takes? Because it takes steps, it takes commitment, discipline, and regularity of investing on an ongoing basis. So if you have long-term goals, that means long-term, right? So you need to set aside things during a long-term process. So the last is 401ks and making sure you set aside your money in your retirement accounts at your current employer. If you have one, you want to be setting money aside. If you don't have an employer that has a 401k, make sure you're setting a money aside for yourself in an IRA. And there's lots of different IRA options. I don't want to take the time to go over those tonight, but make sure you're setting money aside during those balances or during those times, because the more you set aside, the better you'll enjoy life later. So let me give you this I love this chart. It comes from Fidelity. It estimates someone's retirement accounts, what they should look like at their different ages. All right, so if you're age 30, they say you should probably have about 1 times your income in your 401k. Wow. How many do have that now? Some of us might be under 30. Well, guess what? When you get 30, I hope you have at least 1 times your income. Some of us that are older than 30 that might be on this call, you've got to take a good look at the situation here. How am I? How far along am I? Am I on track? And as you age, you can see 35, 40, 45. Boy, when you get to 50, you need 6 times your income. 6 times your income. And then 60 and 7, it's up to 67 is the normal retirement age now. You need about 10 times your income. So 10 times your income at that point in time is important to have because that's going to be the asset that you're going to need to generate enough income added to your Social Security that will provide a very comfortable retirement. I'm not saying a rich retirement, I'm saying a comfortable retirement. So very, very important. This is just a general rule of thumb. Your situation and your numbers will be different because it'll be based on your own situation. But this is a general rule of thumb, a little litmus test of where am I and am I on track? Good stuff. Okay, let's talk about some takeaways. These are just a wrap up of what I've said before, and that is how many have started their OPM plan? Have you organized, set your objectives? Have you started to plan, start to project? Are you monitoring and managing your plan? Also, have you thought about all 5 of those areas, right? Investments, risk management, retirement planning, tax planning, and estate planning. Do you know your risk tolerance level? Making sure you know how much risk to take. And then compare your investments options using the STYLE acronym. Also managing your life risks, making sure you think through those risks and you plan accordingly. And then lastly is start planning and start planning now. So important. The sooner you do it, the better off you're going to be for the long-term life that you'll have. All right, so I'm done. There we go. Questions and answer time. And some of you have emailed questions in. I'll turn it over to our hosts of the meeting. And then today, I hope this is a benefit and hope some people enjoy this, but I'm here. If you have some questions, I'll try to field them.
All right, thanks, Tom. Great information. I'm definitely not where I'm supposed to be at for my age, so thanks for pointing that out.
Okay.
Okay, so we had a few questions come in. One student wants to know if your team is familiar with the TSP military or civilian retirement account.
Yes. There is, yes. We have 8 advisors. I know I have a few advisors that know about it. I personally can't answer direct questions on the topic, but I know we have some advisors that understand the topic and can share what they know and some insights on how to manage that into the process for their own plan. Absolutely.
Perfect. I asked the student if they had any specific questions about it, and they said no. So I think they just wanted to know if your team would be a good team to contact. So that's good. Sure. And then, do you recommend a Roth IRA or a traditional IRA?
Okay, well, here's how I'm going to provide that answer. I'll educate you on the answer because that's a good question. It really is. You need to know a lot more individual information before you answer something like that. But here's a great rule of thumb, though, that I really encourage people to think about. All right, see if you can follow along with my logic. A Roth IRA or a Roth 401k now, they have that in the 401k programs now. Most of them do. It's a great vehicle to save money because when you take the money out of it, you don't pay any taxes on it or the earnings on it. The drawback is you have to pay taxes on the money as it goes in, okay? So you're paying tax on your income now, but usually when you're younger, you're usually at a lower tax bracket. So a rule of thumb is I urge many people that are in the younger stages, earlier stages of their life is to use a Roth and use it heavily and fully. The Roth is a wonderful vehicle because you're going to pay a lower tax on the income. And then when it comes out, whatever the tax bracket you're in doesn't matter. It comes out tax-free. It's awesome. Now, a traditional IRA is the other way around. You actually get a tax deduction when you put it in, but when you take it out is when you pay the tax on the interest. So typically people late in their career, when they already have amassed a very large IRA or 401k, I'll usually recommend to talk about going to a traditional to lower their taxes because usually in their last stage of working time, their later years, they're usually at a highest income they'll ever be, and they're usually at the highest tax brackets. So why not get a lower tax or a tax deduction on those deposits? And then later, a few years later, when you retire, you usually will be in a lower bracket. That's when you can take it out and pay the tax at a lower bracket. So it's how you go about it. So rule of thumb, The younger you are, the better a Roth is because it can accumulate and grow much bigger in a tax-free status for you later.
Great,
Good question.
thank you.
Yep.
Kind of off of that question, is there like a minimum investment for either of those, or
You mean
like
for a Roth or for an IRA?
Yes.
No, pretty much. It depends upon the actual investment vehicle that you're going to recommend or you're going to select. Usually it's $1,000, $2,000 to get started, usually.
Okay.
There is a limit on how much you can put into an IRA, for example. It's I think it's $6,500 this year. Go back and double check my numbers. Yeah, for this year it's $6,500. Last year it was $6,000. Actually, up until you do your taxes, or up until April 15, you can actually put in, if you're going to start an IRA, you can start an IRA now and have it backdated for the prior year. So you can do that, but the limit, the max is $6,000. This year for 23, it's $6,500. Now, once you're over 50 years of age, we call it a catch-up, and they let you put more money in, a little bit more, about $1,000 more, I think it is. Yeah, it's $1,000 more. They haven't changed that. They call it the catch-up provision. They allow you to put not $6,500 in, you could put $7,500 in. But yeah, so get started as soon as you can with whatever you can.
Okay. So now, if you're behind, if you're a person that's behind on the age and the income amount, how do you catch up when trying to make ends meet with bills and living expenses?
Boy, I'll tell you, it is a challenge. And I get it. It is hard. It's hard. And with inflation right now, it's even getting harder. But here, two things I'll call out. One, budgeting. If you can budget your money, you'll find dollars. You truly will. And you'll find dollars and say, wait a minute, where's all this money going? Well, if you budget it and you literally line item it out, you'll discover it where it is. And you'll be able to realign and reassign, for example, some dollars. One less Starbucks every week might help, right? All those little things we can do and are managing and budgeting ourselves. I'm not saying just eat hot dogs and baked beans all the time, right? I'm not saying you have to be, in that kind of stage. I'm calling out just some of the lavishness that we do enjoy. Do we need it? Is it a need or is it a want? There's a needs, we have to take care of our needs. But if it's a want or a desire, do we need it now? That's a call out, okay? Here's the second method, and I like sharing this second method. It's very easy to do, and it's something everyone on this call should be doing it. Every year you get a pay raise. Hopefully, if you're doing a good job and life is good and your employer is treating you well and everything is on a good track, you may get a pay raise. Let's call it 4% last year, 5% last year. What I urge most of my clients and many people is take half of it. Take half of your pay raise and set it aside and commit that to savings. So what did you do? Well, you actually had a 2.5% pay raise, for example. Well, I got 2.5. I can enjoy and spend and have a little bit better life, but also 2.5 went into my 401k plan. Now, my 401k plan, I can keep adding and adding and adding and adding until I hit the maximum amount. The maximum of 401k plan, I think, is $2,200 or $22,000 or something. I have to look at the number, but it's a pretty big number this year. So the reality is you have ample room there to put money away in a 401k and save money automatically out of your paychecks, but do it systematically and do it at a pay raises so that you never see it. So that's the key. It's like going to the painless dentist. My wife mentioned that to me a couple of years ago. It's like going to the painless dentist. A little tug every paycheck, you never feel it. And at the end of the year, guess what? The tooth is gone. So you never felt it. So important to think about, how do I do it systematically and easily? There you go.
Good. Thank you. Okay, so you talked a little bit about a 401k. Now, how can you tell if a 401k offered by your company is a good 401k, or are all 401k programs offered by companies the same?
Right. Well, no, they're not the same. They can vary. There's lots of similarities, and there's some standard provisions in the 401k across all 401ks, but there will be differences and variations. There is every plan, every 401k plan will have some investment options. Now, it all depends upon the employer, how vast and how wide they'll make the investment options. Some are very wide, they give you lots and lots of choices. Some are very narrow, they don't give you many. There is a responsibility by the company or the fiduciary of the plan. There's a fiduciary of the plan. They have a duty to do what's in the best interest of the employees in making sure the plan is a good, strong, suitable plan. So a lot of that has gotten better over the years. More and more plans are really very good and very attractive. Some of the expenses inside the plans are very attractive. They're lower because they're able to pool up the assets together and brings down expenses on the investments. So again, I don't want to be too overly general here, but there are fewer and fewer, I'll say, not attractive plans compared to the years many ago. But I would say today, 401k plans are on the up and the up. Good 401k plan will have many of the options, the general options you'll need. Even some of them might even have an option to do your own investing in your own brokerage account, which is very unique and very special, but it depends upon every employer. But it is, but I would say, take a look at the plan, look at the material that they give you. They're required to give you what they call a SPDA. It's called a summary plan description document. You need to read that document and read the investment selections. They give that to you every year, and you'll have a good look at it and determine what's in your best interest. If you need education, further education on 401ks, that's when you turn to an investment advisor. Some investment advisors can do some great education and help you in that regard to give you good advice in that area. So yes, there's good advice out there as well, but to get started, just get started, right? And once you start building up assets in it, then you want to take a good look at it and see how I can better manage it and diversify it maybe.
Awesome, thank you.
Yep.
How do stocks make money?
Wow. Okay. How do stocks? Well, what are stocks, I guess, is the big question. And maybe that's an easier question to answer. What is a stock? Well, a stock happens to be an ownership of a company. All right. So if you buy one share of Coca-Cola, I think I looked today, Coca-Cola was trading at about $60 a share. What does that mean? Well, to buy one share or one little bit of Coca-Cola, it cost you $60. Well, that stock is valued at $60 based upon the stock market of what others feel that stock is worth. So the stocks can go up and go down in the valuation of the company. So if Coca-Cola does really, really well and continues to grow and expand and come up with new products, and people like still drinking Coke, guess what? The company grows. So your one share or your one little piece of Coca-Cola will grow also in value. And that's when it becomes attractive and people will pay more and more for that share of stock. On the other hand, if something bad happened to Coca-Cola and Coca-Cola went down in their popularity, or they lost sales and they, it was just not a good product any longer, then the valuations drop. So again, a share of stock is a position. It's ownership. You own it. You actually own a piece of Coca-Cola. Now, on the other hand, on the other end of the spectrum, there's something called a bond. A bond is a debt instrument. It's a vehicle where you loan money to somebody or to Coca-Cola. For example, let's use Coca-Cola again. You're going to loan money to Coca-Cola if they have a bond issue. You would literally loan them money and Coca-Cola would promise to pay you that back with interest. Okay? So do you want to loan money and get it back at a fixed rate? Or do you want to take a volatile rate and take the chance on how well Coca-Cola does on growing the company. And if they're very profitable, Coca-Cola, like some companies, they'll pay out profits. When they pay out the profits, they're called dividends. And you look for companies that have dividends, and those dividends are like little extra bonus checks every year or each quarter. They usually send them out quarterly, and they'll tell you, thank you very much. Thank you for owning us. We're sharing some of our profits. Here you go. We're giving you some money back. And I think Coca-Cola dividend rate now is about 3%. So if you bought a Coca-Cola share for $60, 3% is, it's a buck. I think it's $1.80 if I'm doing my math right. So you're going to get $1.80 in dividends every year. So there you get a little bit of interest, basically is your dividend on that stock until you decide to sell that stock later. So there's a little overview crash course on what a stock is and how you make money in stocks.
Perfect. Thank you. Okay,
Yeah.
I think we are going to transition now to an activity.
Okay.
Renee?
Well, thank you all very much.
You know what? Actually, we've got a lot of great questions that we still had from the chat. So let's go ahead and take about another at least 10 minutes or so and keep working on those questions, I think.
Okay, perfect. I can do that. Thank you. Okay, so one of the questions is that somebody had a 401k back in 1999 and they didn't roll it over. How can they figure out where that money is now?
All right, can you repeat that again? It broke up again. What was it again?
A student had a 401k back in 1999 and they
Yep.
did not roll it over.
Yep.
And they want to know how they can figure out where their money is now.
Okay, good question. Excellent question. Your 401k money is still in the 401k. It's with your former employer. You need to reach out to the HR department of that former employer and say, "Hey, I'm no longer there, but there is money in that 401k plan that I put in, and maybe even the company put in. If you're vested, you'll be entitled to some of the employer money if you are vested for it. And you have the right, and you should be getting a statement each year on that 401k plan. They may not have your current address, so maybe that's why you're not getting a statement. But you are required to get a statement each year, and then on top of that, you can move that to another 401k plan if you're with a new employer, or you can take it out and put it into an IRA. As long they call it a transfer or a rollover, you move it into your own personal IRA account, and then you can manage it accordingly. But remember, money that's set aside in retirement is designed for retirement, right? And the government has built their rules and kind of built tax laws around that. So money that's in a 401k is generally for that purpose. So if you take it out before 59 and a half, there's this IRS rule that says you might have to pay a penalty of 10% of the taxes if you take it out and use it for your own pleasure. So you don't want to pay the penalty if you don't want to. And since you already set aside for retirement, I urge you to keep it in a retirement vehicle. So either you roll it, transfer it to your new employer's 401k, or you roll it to your personal IRA. But quick answer, contact your HR department of your former company, and or if you have an old statement, perhaps you can contact that mutual fund company or insurance company, whoever has that name on their 401k statement. If you still have one, they may be able to give you some information as well.
Good, thank you. Okay, so we have one that says that they're a student and they have a part-time job. How can they start a retirement plan now?
Well, you can start an IRA. You can start an IRA if you, you can set money aside for your retirement a little bit. Just start setting it aside. But here's what I would do. If you're still a student, and here's my call out to you, is there are some basic fundamentals when it comes to financial planning. And as much as I get excited and I gear up about retirement planning, I do know there's really basic life needs too, right? Now, the question is, do you have enough set aside in a liquid account? Like at a credit union, we have a wonderful, or the credit union has a wonderful savings share account that people can set money aside, and it's liquid so that you can have it and use it for, excuse me, for emergency funds. So it's important that you need to have some financial base. Remember that financial pyramid? Remember that foundation? Do you have money set aside in case you need money for an emergency? Something happens to your car, it blows up. You need to get a new one. You got to get it fixed, whatever it might be. Do you have money set aside like that for that purpose? If you put everything in retirement and then all of a sudden something bad happens and you need money quickly, then you're in a jam. So I want to make sure you have some thought out process of making sure you have some money set aside. Here's a rule of thumb. 3 months of your normal expenses, 3 months is usually the minimum. 3 months of your normal expenses, you should have set aside in a liquid account in case you would need it, in case you became unemployed, if you were employed, in case you need it for any expenses that came out of the blue. It's just good, safe money management principles to kind of get started. Beyond that, an IRA, yep, absolutely, you can get started there.
Thank you.
Yep.
Okay, what is your opinion on investing in a life insurance policy or indexed universal life insurance or an annuity?
Mm-hmm. Well, those are all insurance products. There are very good insurance products. And there are for purposes and designed for individuals of their certain needs and their stages of life. Okay, like stocks and bonds, and that's not good for everybody. So for me to give a recommendation, yep, stocks and bonds are good for everybody. No, that's not correct. Just like for me to say an annuity or a mutual or a life insurance, a whole life or whatever it might, is that good for everybody? I can't say that either. It's really depending upon the individual person and what their needs are and what their cash flow is and what they're planning to do with the money. And there are some wonderful, when it comes to insurance, I'm a strong believer in insurance. I believe people need it. It's a wonderful vehicle because it creates an estate. It creates an estate for you. If you pass away, there's money for people or to cover your expenses or to provide living for others that you might leave behind. It's a wonderful vehicle for that purpose. So make sure you understand it and you look at it. There's lots of different variations of life insurance policies today. Some things are very short term, hence the word term. Some things you look for the long term, which is more whole life. So you need to look through those and analyze those and have a really good advisor to walk you through and talk you through those. Because a good advisor, one that has a fiduciary standard, and I urge you to look for any advisor that has a fiduciary standard in their practice. What does that mean? That means always looking in your best interest. They're committed to doing that. They're going to give you the recommendation of what's most appropriate for you. So that's very important. But yes, insurance, annuities, we have them in our practice with our clients. I urge many of our clients to have them and continue with them or buy them. But again, it's really specific to their specific needs. Some people it's good for, and some people it isn't.
Thank you. But you're at OneAZ, you guys do offer different insurances?
Yes.
As well.
Our advisors are fully licensed to provide all the different insurance products.
Great. Okay, the next question is, how is a 403B different from a 401k?
Okay. Well, I could really get into a rabbit hole on this. They're basically both a retirement savings vehicle. 401ks are, it's the section that, if you ever know why they call them those names, if you go to the IRS code, look section 401 paragraph K, that tells you what a 401k is. That's how they come up with these names. So 401k is a corporate provision of the corporate or the IRS code to allow companies to create a retirement savings plan for their employees. 403B, that section speaks primarily to nonprofit groups, maybe educational organizations, colleges, universities, etc., nonprofit groups. They'll generally have 403Bs as a retirement savings vehicle. Can they have both? Yes, they can have both. Many people can have both. So it's just a style of an investment or a style of a retirement savings vehicle.
Thank you.
Yep.
So we have about 4 minutes left, and I have a couple questions. Now, if someone is scared of self-investing, would you recommend like the robo-advisors like Fidelity Go or a choice like that? Will you learn how to invest on your own?
Mm-hmm.
What are your recommendations?
Well, okay. Here's some things. If they're talking, there are some, in some of the brokerage firms, you mentioned one, Fidelity, Schwab. I mean, all of the big firms have, I'll call it the self-serve model, where you use the term robo, kind of like a robot doing it. Those are available, and they are, they do their job to help people, educate people, and provide good solutions. I'm also a believer of good counsel and good advice from an individual that would actually talk to you, get to know you a little bit more than maybe just a series of questions that a robot would do. Usually they'll get to know you or your family needs and find out what your long-term desires are, and they'll ask you what your sleep factor is. I call it the sleep factor, how much risk to take. You can certainly do it on your own, and those vehicles are there. And I'm not going to say they're not good, but they're just a style and they're available. But you can also reach out to an actual advisor and talk to an advisor and get some counsel. Just because you go talk to one doesn't mean you have to do business with them. Interview them, make sure they hear you, make sure you feel comfortable with the person that you talk with, make sure they're a fiduciary. That's one call out I would ask you to look for. Make sure they're going to look to your best interest. Will they help you? Will they educate you? Will they take on your account of your size? Some firms have large, high minimum requirements. Some have low. We have a low minimum requirement because we want to make our available services to the general public, to the market, to the community overall. So you look for those. Those are some of the call outs I would say when you're thinking about where you should go. But yes, the answer to the question, do robos exist? They do. Are they good? Yes, some of them are good. They actually provide some really good education as well.
Thank you. Okay, I think we have time for one more question. Hopefully we can get through it quickly. Should a person invest in one company or split their investments with several different companies?
Mm-hmm. Well, that question is asking about diversification, right? Should I buy Coca-Cola only, or should I buy Coca-Cola, Pepsi, and I don't know, name another beverage company? I mean, that's called diversification, spreading your risk across. Take a look at computer systems, right? Apple or Samsung, or what other systems there might be out there. It's knowing, how do I diversify? Should I buy all Tesla, or should I buy some of the other EV companies? EV stands for electric vehicles, electronic vehicles. So how do I diversify? I'm a believer of diversification because it spreads risk. Because if something bad happens to one, doesn't mean they all typically go down. Sometimes they do, but generally speaking, diversification allows a blending of risk, a blending and also a reduction of risk. The more spread out you are. If you remember to my jelly bean chart, right? That jelly bean chart, that dark gray box was a diversified portfolio. It was a little less rocky. It still got to the end with some good returns. It was just a little less volatile. Didn't have as highs, didn't have as lows, but it was very well balanced. So it got to my endpoint better. But if you really firmly believe in one company, then you have to understand the risk you're taking and understand that investing in just one company, you're living and dying on the performance of that one company. I've been in the industry 30, 40 years, and I can tell you, I believed in some companies, and some of those companies do not exist anymore today. So did I lose money? Yes, I lost all my money in a couple investment selections I made simply because that was one bet, one company. But overall, if you pick an industry or you blend it out in a mutual fund or to a group of individual stocks or an industry, then you're going to have a little bit better chances of success and a little less chance for of loss. So there you go.
All right, so we have a couple more questions, they said, or a couple more minutes before we have to transition. Now, if somebody wants to get started with OneAZ, how would they go about scheduling an appointment, or what would their first steps be?
Sure. Well, actually, we have our QR code right up there on the screen. They could go on there. You can go to our website, go and look at one of the advisors that we have listed. There's a tab for advisors. Click on one of them in the region or pick a branch that you're close to, and you'll actually, you can actually schedule a phone consultation or a Zoom meeting even with one of the advisors on a specific time. So you can book your own time with them over the phone to introduce yourself. Or you can simply call us. Call the number 877-566-0517. Say that you were on this call, you would like to talk to an advisor, I have a really great advisor. His name is Zach Hawley, that is available for, I call it our centralized unit and handling people mostly over the phone. He's really good. He might be a great resource. But any of the advisors, all of them are great individuals. They're well licensed and they all follow a fiduciary standard in their recommendations for clients.
Okay. Wow, thank you so much, Tom. This has been a great wealth of information. Thank you. I measured myself with the information you provided, and I think you'll definitely be hearing from us soon. I'm definitely not ready, but thank you. This was great. I hope everybody enjoyed that. But with that, I do want to share some information with you all. Just quick announcements. You will be shared some additional resources that we have prepared for you along investment and retirement, in addition to the information that the slides that were shared today will also be shared, as well as the recording. I know there was a question earlier about it, so we will be sharing that as well. And so we do want to thank everyone who followed us on social media, for our accounts for Pima's first year experience and for the Office of Financial Aid and Scholarships. So those who did were entered into a drawing while Tom was sharing his information, and the winners are, so you would normally hear a drum roll right now. I won't do it, but so the winners are Christina Royalston for first year experience, and Kayla Sanchez for the Office of Financial Aid and Scholarships. Congratulations. So what will you each win? So each of you will win a prize bundle, which includes a mix of these prize options from Pima Community College, the Office of Financial Aid and Scholarships, and first year experience. You can see them on the screen, so they're kind of cool swag. We will send you your prize package soon to the mailing address provided in your Pima student profile. So please allow a few weeks for us to get things packaged and delivered to you in the mail. And if you haven't received your prize by this time next month, please do not hesitate to follow up with us so we can troubleshoot and track your shipment. So congratulations again to the winners. In addition, I do want to share that what everybody, your feedback is greatly appreciated, very important to us. So thank you everyone for attending the first Money Matters session of the semester. We hope that you found great value in the information shared today and that you enjoyed the session. We do want to let you know that we do have one more session coming up for the semester, April 6th. at same time, 4:30 to 6, and it's on credit scores, also presented and facilitated by OneAZ. So please make sure you RSVP at the link that will be shared shortly in the chat. And a reminder also that when you attend all 2 Spring Money Matters sessions, you will also be entered into another drawing for a $250 award that you can apply to your tuition at Pima Community College, either for the summer of 2023 or fall of 2023 semester. So remember, there is also an additional prize opportunity to win by visiting the partnership page between Pima and OneAZ, which you can see on the screen at this time. A link will also be shared with you. And so if you visit, the sweepstakes begin today and will end Thursday, March 16th, 2023 at 5 p.m. And the winner will be selected on Thursday, March 16th by a random drawing. And the prize will need to be picked up at one of the OneAZ branches, but the value of the prize is $150. So please check out the website for OneAZ and Pima. And at last, we'd also like to take a moment to ask you to take a moment to complete the survey to let us know how we did. Your feedback is greatly appreciated. It helps us know what you would like to learn more about, and also let us know how we're doing and how we can improve. So thank you for that. So also completing the survey does earn you a certificate of completion, which will be mailed to you in the next couple of weeks. So again, a huge thanks to our partners from OneAZ, Tom Mitchell and Vanessa Alfaro. Thank you so much for your partnership. Renee Forsyth from First Year Experience, thank you so much. And to the team of the Office of Financial Aid and Scholarships, thank you so much for being here today. So if you would like to follow up and contact us with any information or questions you may have, sorry, I'll go back. I wanted to share the, this is the sweepstakes, so I'll give you a moment from OneAZ for you to be able to earn the $150. So you can see the QR code.
Yes, another great QR code, Carla. We're doing the $100 Visa gift card this time with OneAZ swag. You mentioned that it's $150 total. And that website that you had up there, you can scan that there to register. You do not have to be a member of the credit union yet, although we'd love to have you. That's the first step of also getting those complimentary wealth advisors to sit down with and speak with. But remember, through this partnership, you also get $100 if you're a student and you decide to become a member of the credit union. But again, you don't need that in order to use this QR code to register for the prize, which again, Carla, you mentioned registration ends March 16th, but we will select a winner and you'll be able to pick this up at any of our Tucson branches that are convenient for you. So we're excited to have you as a member. If you need more information on that, you can visit the website or reach out to me directly and I'll get you with a personal banker here locally. Thanks, Carla, for sharing that.
Thank you. All right. And again, thank you for everyone for attending. If you can scan the QR code, you can complete the survey. So again, the survey does earn you a certificate of completion. So please make sure you do that. And don't forget to RSVP for our next event. And if you need to contact us or follow up with us regarding any information, these are our contact emails and how you can reach us. So once again, thank you all for joining us tonight, and we appreciate your participation, and we look forward to seeing you here next time.